Friends, this is a fast forward session. In this session, I am going to discuss the measures taken by the RBI for mitigating the adverse impact of the coronavirus lockdown. So our census is going down, our economy is not good in good health. Various measures have been taken by the government. The RBI governor has actually taken all these measures along with the Monetary Policy Committee. They fall in the category of expansion of liquidity, increasing the monetary transmission, relaxing the repayment of pressure, and improving the functioning of the market. First of all measures have been taken to expand the liquidity? There are multiple options with the bank: CRR, SLR, liquidity adjustment facility, and MSF. All these have been touched. The government is continuing with the accommodative stance. That means increasing the money supply during the time of stress. So we are continuing with the accommodative stance from last more than 1 year. Repo rate means the rate at which RBI provides loan to the commercial bank and commercial banks keep with the government security. This repo rate has been decreased by 0.75% and now this is 4%. Fixed reverse repo rate is completely opposite of the repo rate, and in which RBI takes loan from the commercial bank, and now this has been reduced from 4.9% to 4%. So earlier the difference between the reverse repo rate and repo rate was 0.25%. Now this difference has been increased by 0.15%. So now difference is 0.4%. Why this increase? This increase so that RBI is encouraging the bank not to come to the RBI, rather go to the market to give the loan, right? Targeted long-term repo operation. Long-term repo operation is basically for more than 1 day. Normally the repo operation is for 1 day, but long-term is for up to 3 years. So this new tool has been used by the RBI in the recent month. Earlier there was variable long-term repo operation, just like this only, where the rate of interest will be linked to the repo rate and it will be variable. The bank can choose, they can quote whatever amount they want to pay, but it should be above repo rate, and RBI will give loan to those banks who are offering the maximum interest rate to the RBI. So this facility has been given so that more and more working capital can be provided to the businessman, and this amount should be invested either into the corporate bond, commercial paper, non-convertible debenture, or so that it can become the working capital. What is corporate bond? Corporate bond is basically security which is issued by the company. So this is the kind of loan which is taken by the company from the investors, and in this case the company promises a certain regular interest payment, right? So there is a commitment of interest. The investors get the regular return, unlike the shareholder. In case of shareholder, the shareholder becomes the owner of the company, but shareholder has no promise of regular income from the company. Then we have non-convertible debenture. So debenture are just like bond only. So debenture can be either convertible, that means after some time the debenture will be converted into the equity shareholders. So from the loan giver, they can become the owner of the company. Non-convertible debenture means those debentures which have no condition to be converted. The benefit of non-convertible debenture is that they get higher rate of interest, they have tax exemption, they are much more safe, and minimum maturity period is 90 days. Commercial papers. So in case of companies which have high rating, which have good standing in the market, they can issue the commercial papers, and in the case of commercial paper, they are basically short-term debt. That means loan. Short term means up to 1 year. That is why they are also called as the money market instrument, and they are unsecured, means the company is not giving any collateral. The commercial paper issuing company is not giving any collateral, and they are issued in the denomination of 5 lakh or more. MSF, marginal standing facility, is an extra facility which is given up to 2% of NDTL. NDTL means total deposit of the bank. Now this 2% has been increased to the 3%, right? And this 3% is actually taken from the RBI by keeping government security from the SLR portion, statutory liquidity ratio portion, with the RBI, right? This MSF is available at the rate of repo rate plus 0.25%. So repo rate is now 4.4%. This 0.25% addition will mean MSF is available at 4.65%. So rate of interest has been reduced, and the limit has been increased from 2% to 3%. Monetary policy rate corridor has been increased. So earlier repo rate was 5.5, 5.15, and there was difference of 0.25 on either side for the MSF and reverse repo rate. So the corridor was 0.5%. Now the corridor has been increased to 0.65% because between repo rate and reverse repo rate, the rate has been, the distance has been increased by 0.15%. CRR, the amount which has to be kept by the bank with the RBI without taking any income, is decreased from 4% to 3%. That means they have 1% of NDTL, 1% of total deposit extra money to lend to the market. So this will increase the liquidity. Then regulation and supervision measures. In this case, in case of term loan, the EMI repayment have been postponed by 3 months. Again, this is an advice from the side of RBI. This is not an order. So individual banks have to come up with their policies. They might put some condition. Working capital facility interest has been allowed to be deferred. So working capital here, particularly cash credit. In case of cash credit, whatever is the sanction amount, the interest is charged on that amount which is used by the borrower. So if borrower is using only 1 lakh out of the total 10 lakh rupees, the borrower has to pay the interest only on 1 lakh rupees, not on the 10 lakh rupees. So this interest can be deferred by up to 3 months. Net stable funding. Stable funding means the source of funding which can provide the stable source of funding, like infusion of capital by the bank. Capital conservation buffer, which is part of the Basel norms, and it is component of the capital adequacy ratio up to 2.5%. This capital conservation buffer is nothing but the surplus capital which is taken aside during the ordinary time so that this money can be used in the times of stress. So this money was supposed to be kept by up to 2.5% of the risk-weighted asset. Now the duration or the maximum time limit for maintaining this capital conservation buffer has been increased by 6 months, right? So with all these measures, the normal person, the middleman, the taxpayer, the EMI payer, the people like me and you, businessmen, we all can sleep with peace of mind. So I hope you enjoyed the revisionary lecture. Thank you very much. The complete session on this topic I have already made with complete discussion about everything. If you are a beginner, if you have just started the preparation or your economy is not good, you must watch that particular lecture. If you are expert in economy, just want an updation, that you should use this particular lecture. Thank you very much. God bless you.